Hey there, macro folks. This is Mr. Hooker, and this is Money, Banking, and the Federal Reserve System, video number 4. So, as I mentioned in the last one, check out that video for um, the best or the new Federal Reserve monetary policies. I have some slides here that I put in that have the current monetary policy tools. So, here the current tools are. Um, Open market operations, the administered rates, forward guidance, and then the federal funds rate. So let's talk about these. I've got some slides on some of these. So let's talk about the ones we have right here. The open market operations, it's just the buying and selling. That one was in the previous set of tools. That's basically just the buying and selling of government securities. So if the government wants to increase the money supply, they will buy securities. That takes the securities out of the bank's hands. It puts monies in there and puts money in their hands, which will immediately increase excess reserves, which is really not excess reserves anymore. It's just reserves now. Um, and then if they want to take money out of supply, they sell securities, which means the banks have to give them money. They give them securities. You can't loan money on securities. So basically, they can't make as many loans. Um, so that just raises the interest rate. That happens. The administered rates are all the rates that the government controls, like the discount rate and some other rates that they pay, the interest on reserve balances and all that. We'll talk about that in a second. Forward guidance. If you've ever listened to the Fed when they have their talks every quarter, they will say like, "Hey, well, not the hey part, but we are cutting um, the the discount rate, or we're cutting the rate by 0.25 basis points. So basis point, by 25 basis points. 25 basis points just means 0.25%. Okay. So 100 basis points is 1%. That's basically all that is. Um, and then they'll say, and so that's the current piece. And then, or they'll say, we're going to leave the rate like it is, but we do expect to possibly make rate cuts in the future, or possibly make rate increases in the future. And so those possibly making rate cuts or increases in the future is what we call forward guidance. So they're giving you an indication of where they're going 3 months from today, 90-day window. And that 90-day window tells you, about their next meeting. So it's the 90-day window that will influence financial markets. So the people who do stocks and bonds really care about that 90-day window about, hey, what are the interest rates going to be like? What are things going to be like? How's my borrowing going to be? And the federal funds rate, as I mentioned in the last video, is just simply what rate banks can borrow from each other at. That is the policy rate for the Fed right now. So the administered rates at the moment are the interest rate on reserve balances. So if you are a bank, you keep reserves in one of two places. One is your vault. You don't get paid jack for keeping money in your vault. It is yours. Have fun with that. Go do Scrooge McDuck stuff with that. The other place that you can keep it is the Federal Reserve. Now, if you keep money at the Federal Reserve pays you interest. Now, that rate may go up or down. If they would like you to keep more money at the Federal Reserve, they will raise that interest rate. If they would like you to keep less money at the Federal Reserve, they will lower that interest rate. And that is a signal that, hey, we would like you to loan money. If they raise it, it's like, hey, we would like you to keep money with us. Overnight reverse repo rate. There are some institutions that are not eligible to keep money at the Federal Reserve. So we looked at some earlier, the hedge fund, the money market people. So insurance companies, there are some financial institutions not eligible for that. What do? We have overnight reverse repo. Did I spell that? Yeah, I did. So I have reserve repo. It's supposed to be reverse repo. Um, I'll fix that. It's supposed to be reverse repo rate. So it's a reverse repo rate, and I bet money that was a autocorrect kind of thing. But it's an overnight reverse repo rate. So what is that? Reverse repo is just basically a loan on a security. That is all that is. So it's just influence on the money market for those that are not actually banks. Discount rate. The Fed has full credibility to enforce all of their administered rates. So the discount rate is that third rate. That's the rate that you borrow from the Fed. Like you need to go to the discount window. It's the interest rate that you would borrow at the Fed. And the Fed has the full credibility to enforce all of their administered rates. So their forward guidance is the communication to the public on how the Fed sees the state of the economy, and two, intends to conduct monetary policy going forward. Um, so that is how that is. Individuals and businesses use the information to shape their financial decisions. So, as I mentioned, it's a 90-day window. People will use that information to shape whatever decisions they have financially, and it could affect the nation's money supply. Basically, if we think that the interest rates are going to go up, we could do some things now, especially if they say that they think they may have to raise the rates during these periods of inflation where they thought they may have to increase the rate some. If you think the rates are going to go up, you may want to borrow now at what you believe to be the cheaper rate. So that's where people start doing those kind of things. So open market operations and reverse repo operations. So like anything, like any bank, the Federal Reserve has assets and liabilities. If you're an accounting major, I'm just going to say this now. Bank assets and liabilities are completely opposite from a normal company's assets and liabilities. Please do not get tied up in bank asset liability kind of thing. They're completely opposite. Okay. Um, so the Fed's assets are mainly short-term U.S. government bonds, known as U.S. T-bills, and the liabilities are currency in circulation and their reserves. So that is what that looks like for the bank balance sheet. So their assets are their debt, their treasury bills. And you have to think of it from like the bank being the business. When the bank is the business, their asset is a little bit different than the normal business. So when you look at it, it makes sense. Um, so open market operations and reverse repos. In the open market operations, Federal Reserve buys and sells treasury bills, normally through a transaction with commercial banks, um, and some investment banks. So investment banks are banks that create and trade assets but don't accept deposits. Um, but the Fed never buys U.S. Treasury bills directly from the federal government. Um, if it did, it would be printing money to fund the budget deficit, and that would just trigger inflation. So the Fed is not the one buying U.S. T bills from the government. Now, the government holds debt, but the Fed did not sell it or buy it from the government. That just don't happen. So the government buys debt, holds debt, it holds its debt in a different way. All right. So open market operations on this. So for panel A, the Fed buys 100 million of T-bills from banks. They electronically increase the seller's reserves. With more reserves, the banks can increase loans. And as banks increase loans, the money supply increases via the multiplier. Now, Fed panel B here. The Fed sells 100 million of T-bills to the banks, decreasing the bank's reserves. So now the banks have less reserves. They have to decrease their loans. And honestly, if you've ever had a loan and never read your documents, and you wouldn't be the first, most people don't fully read their loan document. There is a clause in there that they can call your loan if it is within, and normally that time frame is 6 months. So if it's within 6 months, some are a year, but mostly it's 6 months. I have been one of those people that had to call somebody and say, hey, by the way, your loan is 4 months from due, and we are going to call it. And the guy on the other end was like, hey, what? I said, we're calling your loan. So we need you to make payment in the next 30 days. It was one of those where I got cussed out over the next minute and a half or so. Hey, kind of what I was getting paid to do, though. So yeah, those happen. Typically, that clause is 6 months. It can be a year, but yeah, if you have a loan, when you get to the end of your loan, they can decide that they would like their money today, not later. If they do that, probably a sign that you don't need to be with that bank. So what y'all probably don't know, banks are rated 1 to 5. 1 is a great bank, never seen a 1. 2 is a really good bank. There's a lot of 2s. 3 is the average bank. Average is average. 4 is a bad bank. I worked for a 4. That was the bank where I was calling loans on people. And then 5 is a bank so bad the RTC just showed up and started repossessing your assets. Never been at a 5 bank before. So that's the way that works. So practice question 4, suppose it's the only bank and all money is held by this bank. There are no excess reserves, so they are what we call loaned up. If the Fed makes an open market sale of T-bills worth $50 to this bank, so they sell T-bills worth $50 to this bank, what will happen to the money supply after the adjustments are made? So if they're selling T-bills, they're taking that money out. So it would decrease by 500. So, and that's because it's 50 and you got the required reserves of 100. So you basically got a money multiplier of required reserves of 100, deposits of 1,000, money multiplier of 10. So 50 times 10 is 500. European Central Bank, their version of the Fed, rivals the Fed in terms of importance to the world economy. Created in 99, when 11 European nations abandoned their national currencies, adopted the euro, and placed their joint monetary policy in the ECB's hand. It is in Frankfurt, Germany. Represents a combined economy as large as that of the United States. So there you go. Um, Analogies between ECB and the Fed. Europe's national banks, the Bank of France, Bank of Italy, are like regional feds. They provide financial services to local banks and businesses and conduct open market operations. The counterpart of the Fed's Board of Governors is the ECB's Executive Board. The counterpart of the FOMC is the ECB's Governing Council. And just like the Fed's Open Market Committee consists of the Board of Governors plus a rotating group of regional Fed presidents, the ECB's Governing Council consists of the Executive Board plus the heads of the national central banks. So, like the Fed, the ECB is ultimately answerable to voters, and it tries to maintain its independence from short term political pressure. So, let's talk about that FOMC, the Federal Open Market Committee. So that consists of 12 members. So you have the 7 members of the Board of Governors, which I mentioned before, appointed by the president, confirmed by the Senate. So there's 7 Board of Governor members. And then there are 5 regional presidents. So the way that works, all 12 regional presidents go to the meeting, 5 are voting. 7 are just there for consult. New York is always on, 4 rotate. That is the way the Federal Open Market Committee works. Federal Open Market Committee determines the purchase and sale of market securities. So they do all the open market transactions. The reason New York is always on is because of the open market desk being in New York. All right. And so that is a great place to stop. We will get back into this in video number 5.